Welcome to today's webinar, CIO's Insight on the Insurance Sector, hosted by CFA Institute. I would like to take a moment to welcome our audience from around the world joining us remotely. My name is Dheeraj. I work as a director with Abacus Asset Manager, a boutique AMC with PMS and Category 3 alternative investment funds. And I'll be your moderator for today's webinar. Some housekeeping notes before I introduce our speakers. Today's webinar is scheduled for 60 minutes, including Q&A. First 45 minutes will be used for the presentation, and last 15 minutes will be used for the Q&A session. We will be leaving enough time for the Q&A after the presentation. So feel free to submit your questions throughout the presentation on the Q&A tab. The webinar presentation will be available to view after the presentation concludes in the chat box. We'll provide a link to download the presentation. We value your feedback, so please complete the evaluation survey before you sign off today. Now it's my pleasure to introduce our speaker for today's webinar, Dheeraj Agarwal, CFA. Welcome, Dheeraj. Dheeraj is a Chief Investment Officer with Aditya Birla Health Insurance Company Limited. He has set up the entire firm's investment desk, including investments, credit policies, SOPs, etc. Prior to joining Aditya Birla Health Insurance, Dheeraj worked at IDBI Bank for almost a decade, where he has hands-on experience on the money market and fixed income desk. So he has moved his careers managing about 50,000 crores of bank's SLR portfolio to now an insurance company. Dheeraj holds a bachelor's degree of science in mathematics and a master's of business administration in finance from University of Mumbai. He's a CFA charter holder. Thank you, Dheeraj. As a reminder, all of you can submit your questions on the Q&A tab at the bottom of the deck. I will be managing the Q&A sessions. And Dheeraj, over to you.
Thanks, BD. And a very good evening to everyone. My name is Dheeraj Agarwal, and I take care of the investment portfolio of Aditya Birla Health Insurance. I'm a BSc graduate in maths and then MBA in finance. And then I completed my CA in 2019. So today I will be giving you a brief presentation, and we will discuss about the investment strategies, how the sector manages the investment portfolio. So for that, I have divided the whole presentation in two parts. First, I will give you the brief of the insurance sector, how it is performing in India and what are the potential we have going forward. And then we will go, what are the nuances and style and strategies we follow to manage the investment portfolio for insurance companies. So to start with, an overview. So insurance, so as you know, I mean, what is insurance? Insurance is just like the redistribution of the risk. So it transfers the risk from one individual to the common pool. And the country where every sector is growing, it is one of the fastest growing sector. And we can see that there are 24 life insurance companies. There are 27 health insurance companies, and there are 27 general insurance companies and 6 health insurance companies. Earlier, this health insurance and general was combined, but seeing the opportunity in the health insurance sector, now companies are coming with standalone health insurance profile, so that they can manage the growing sector and can focus more on this sector, which is growing faster than the other life and general insurance. Now, on the AUM side, we see that around the total management of life insurance is around 39 lakh crores, which is more than $500 billion. And the bigger pie is with our biggest investor, that is LIC. It manages around 30 lakh 70,000 crores, and around 8 lakh 19,000 crores is managed by private players. On non-life insurance companies, it's around more than 3 lakh 50,000 crores AUM, which is managed among general insurance, health insurance, reinsurance, and other players. We'll move ahead. So when we talk about the opportunity and the penetration of insurance sector in India, we see that still we are lagging in terms of the penetration as compared to the global percentage. India is around 2.82 in life insurance and 0.94 in non-life insurance. And if you see the global percentage, it is around 3.35 in life and 3.88, which is much higher in non-life insurance. So we can assume, what potential we have going forward for the general insurance or non-life insurance companies. If you see the density is very low. We are just 1/6 of the global average. And in terms of non-life, it is nothing. I mean, it as compared to the global density, which is around $439, as compared to ours is 19. So there's a potential, huge potential, which can be fulfilled, or which can be which gives a big opportunity for all the players. If you see the total premium collection in last 8 years, it has grown around 2.56 lakh crores to more than 7 lakh crores. And the compound annual growth rate has been around 14% in last in this 8 years. Precisely, I can say that in next 5 to 10 years, we can also assume that we will see roughly 15% CAGR minimum going ahead, because we have both the thing. The penetration is low and the density is low. So in both the terms, the volume should be very high, and there is enough room for all the players, whether it is a private player or public insurance companies. So, private. So, if you see the data, we find that in the last 15, 20 years, private sector has grown tremendously. I mean, from 2% in FY03 to FY20, it is around. I mean, it has multiplied their market share in life insurance as well as in private sector in non-life insurance. In non-life insurance, they are now of the majority. I mean, more than 50% is market share is owned by private sector. In life insurance, still LIC is the biggest player, but the way private sector is catching up, it could be that in few years we may see that private sectors are, contributing, taking a huge, bigger pie of the overall life insurance business. And government is also matching their commitment while increasing the FDI limit from 49% to 74%. It will definitely, what will it do? It will give much impetus to the sector by providing new technologies, because the insurance sector requires this investment. So this 49 to 74% gives the ample opportunity for all the big global players. And in India, we see that all the big global players are already having partnership with the Indian players, whether it is Alliance, Exxon, Nippon, Prudent, and many others. And many others are lined up to invest in India. So because the opportunity is huge, and if you see the global trend, India is one of the fastest insurance market, which is growing at a much higher level than the global growth. So in last few years, as in every sector, digitalization has changed the work of every sector. So why the insurance is not away from that? There are few companies which have introduced very new technologies, and they have come up with the mindset that they will completely change the play in the insurance sector. And there are few companies where their commitment was they will be going fully digital, but in the practicality, it is fully digital. So they are also now moving towards the mix of digital and traditional style. So there will be difference between companies. So the operating costs will be reduced by this digitalization, because there will be no paperwork. The buying procedures will be changed, because online people will be taking insurance policies giving their health. Now I tell you that their technologies are going on where your webcam will be taking your there will be no need for a health checkup, and other information will be taken just through online process. So the claim process, which was one of the most biggest hassle for the customers, that will be everything will be done through website automation. Customer communication. Earlier, we used to take the companies used to take time for to respond. Now we have an instant live. So overall, provide a new experience for the customers, and it will put pressure on other traditional players that move ahead. Otherwise, going forward, they will be losing their share to these players. So, India is a country which has been a laggard in terms of the social security. But now, in last few years, government has taken many steps. In one of the steps is that Pradhan Mantri Jeevan Jyoti Bima Yojana. It was 2018 to population, almost half of the population, and it was 5 lakhs per family. The world's largest health scheme, and we can see that it is a positive thing also for the life insurance companies, because if government is saying that if government is saying that per family rupees 5 lakh is important to give health insurance cover. So the ticket size of Indian life existing life insurance life and health insurance companies are increasing. So earlier in our company also we are experiencing a bigger ticket size, because we can say the customer that if government is saying that the poor family should have an cover of 5 lakh, must be a higher cover on that side. So on the ground, we can see that the states which have implemented this Pradhan Mantri Jeevan Jyoti Bima Yojana, there the infant and child have decreased. So it is very good for the overall society. Now the new thing which was introduced in the was national pension system, because of the lack of the social security. Has been introduced by the government, and currently the total AUM of NPS and Atal Pension Yojana is around 5 lakh crore. The biggest benefit is it is one of the lowest cost product available in the market. It is the flexibility. We can change our asset class as per our requirement, and it is tax efficient also. Other than it is a special benefit for investing in NPS. And the biggest concern with the investors were about the annuity, where government has said that the minimum 40% should be 40% should be given to annuity, and only 60% can be withdrawn at the time of maturity. So on that concern, they are working to introduce some systematic withdrawal plan, which will be an additional option to the annuity. And Atal Pension Yojana is a very welcome step provided to all the unorganized people in the country, where they can invest, and government is also contributing to this plan, which will give which will streamline the cash flow for the people who after the age of 60, where they find it very difficult to for their livelihood. So going forward, we see that still NPS is under penetrated, and the AUM is though crossed 5 lakh crore, but most of them are coming from government employees, and the purpose of it will be fulfilled when there will be a huge number of other than government employees taking NPS scheme. So I mean, slowly government is making it more attractive so that others can also invest in NPS. It will give, a very good competition to all the insurance players because of this low cost. I can't imagine that at 0.1% you can get any product in the market, whether it is insurance, mutual fund, or anything else. So the opportunities. So definitely, on the opportunity side, there is a robust demand. Whether it is I shared with you on all these, whether it is a penetration or whether it is the density in both side, there will be a 15%, more than 15% CAGR for next 5 to 10 years. Awareness of insurance need. Earlier, people were just taking only health, life insurance. They were not aware of health insurance and other things. And that is still the term insurance penetration in India is very low. So this awareness among other people, introduction of this Pradhan Mantri Yojana, and all these are giving impetus to the industry and giving awareness to the people that how insurance is required for their family. This pandemic also has given thought that it can give. It is very important for anyone. So high penetration of digital platform. This India is witnessing a very good growth in this telecom, and it is giving impetus to the digital platform. So, going forward, the whole interaction with the customer will change. Then challenges, definitely, the customers are expecting more and more. There are the penetration of rural India is very low. Still, we need to reach the bottom of the pyramid, the customer at the bottom of the pyramid. And the competition is so huge that still many insurance companies are making losses after so many years of operation. But the opportunity is so huge that everybody is ready to invest. And going forward, we may see a very big and profitable opportunities. So now the next part is the investment portfolio management. So why should we are here and managing the investment portfolio? Because the main purpose of investment portfolio in insurance company is to consistent with the risk profile of the company, and it will be prudently managed with after fulfilling all the liquidity needs. And why it is required? It is required because it helps to increase the profitability of the company, and ultimately it reduces the premium, and which makes policy more attractive. There are four areas where investment process is required to be is required to be managed efficiently. One is risk management, second is ALM, third is asset allocation, and fourth is investment style. One by one, we will go through all these four areas, and we will see that how things are done in this insurance sector. So first thing is investment process. To manage any investment portfolio, the biggest challenge is the regulatory limits. As in a personal portfolio, you can invest anywhere. But because it's a public money, there is a certain regulation prescribed by the authorities. So for the asset class, for the every sector, there is a limit. So before starting any investment, we must see what are the regulatory limits and what are the internal limits set by the individual company. Then the second important part is the liquidity. Because all the money is invested to meet some expenses and to fulfill all the liabilities. So the assets in which we invest, we see what is the liquidity. If the demand arises, will I be able to sell that with the minimal impact cost, and how it will impact my P&L. if in distress conditions. So liquidity is a very important plays an important role, and that is why the liquid assets yield a little lower return as compared to the illiquid assets. Then it comes to safety. So safety is also important. I mean, we can see in last few years many defaults have happened. So the safety of asset class is managed by two things. First, internal and then external. Also external through rating agencies, we get the information how the company is performing and what is the view of their, and then we also do the analysis inside the company, I mean internal analysis, and then we go for the investment. Diversification, I mean many people understand that the equity is the biggest market. I mean not all, but many people. But if you see that, I mean the biggest investment or most of the investment for insurance sector happens in bond market, because here the predictability is high. I mean, in equity, though in the longer term, equity has given a better return than bond market, but because of the cash flow prediction, because the certainty, and because impact cost is low, when it could be that it could be that for equity, there could be some bad phases in which it will be very difficult to sell those investments. So majority of the investments are in bond, in the debt market by the insurance companies, but definitely they take the advantage of the diversification through investing in equity. So depending on their profile, it could be 5%, 10%, 20%. It depends on the company to company, their risk profile and appetite. Second part is the risk management. So first and foremost thing to invest for the insurance companies, adhere with the investment policy. Um, Everything which we do, first we go through the investment policy, whether it is complying or not. Then comes to credit risk, then liquidity risk, then market risk. Credit risk is much you are aware of that how the company will be performing and what is the probability of default. I mean, we can see that, last a few years, we can see that some high rated companies have defaulted. So it is very important for the company to do internal analysis, not only dependent on the external rating agencies. Then we do the market analysis. I mean, you can see that yields are going up globally in India also. So these market analyses are required to do before investment. Then we do the scenario analysis, that what could be the probable loss or what could be the probable MTM going forward if yield goes from, let's say, from here to 20 basis, 25 basis or 50 basis above than that. And also important part is control and reporting. As in any insurance company, there is a quarterly investment committee wherein we give all the information regarding the investment activities and other things. So, and there is a regular control also, wherein the limits, the VAR, and the other things are managed on daily basis, which is related to liquidity, which is related to credit risk, which is related to market risk. See the volatility, how the volatility is there. If we find that the war of any particular security or any particular sector is increasing, then we try to reduce those risks, or we can take a view how things are going ahead. So now part of any financial institution is the managing ALM. It's managing interest rate risk and liquidity risk to prevent mismatch between the cash flows of the assets and the cash flow of the liability. So price sensitivity gap is difference between the value of rate sensitivity assets and liability for various maturity buckets. How the asset and liability will react to a particular condition. Then a liquidity gap. Liquidity gap is very important, whether it is an insurance company or whether it is a bank. So we check the liquidity scenario for each bracket. It is not necessary that there will be always a gap will always be positive. In few cases, it may be negative. There are certain guidelines provided by the RBI or IRDA and other regulatory entities, how to manage those liquidity gaps. Because if you go to bridge all those gaps, they will be costly, and it will cost a lot for the company. So the best way to manage the liquidity gap is you can keep the liquidity. There is a difference between the asset liability, but there should be managed through your liquid investments. Whenever there is a requirement of funds, you must be able to sell those assets. That in net interest income, it is to evaluate the impact of interest rate on the earnings. It takes the various interest rate structure, I mean, whether it is parallel, non-parallel. You can do analysis as per your requirement and as per your will, which will give which will tell you the change in the bank's net income. And other part is the better part is that duration gap. Next part is duration gap. It is a tool to manage to see the firm's net worth from the serious implications of interest rates. Uh, it also sees what would be the impact of the market value of bank equity. So considering all those things, the best way to manage the ALM is how to fulfill all the liabilities without fail in time. And to manage it, there will be some cost. So you have to reduce those costs and also give the best return. In that, there is a risk involved here, that is the interest rate risks, because I mean, every time your the duration or of your assets and duration of your liability cannot be same. So how will you manage that? What are the solutions you have? It could be that you have some very good liquid assets, so that you can keep a little bit higher duration, or you can invest in higher duration assets, but your liability is lower. But in the time of fund requirement, you can sell those securities at a very minimal impact cost. Now, what are the investment styles that we do? See, investment style depends on the investment manager and the company and the sector, insurance sector, or whether it is a mutual fund or whether it is banks or insurance companies. So one of the style is the spread. So spread could be among asset class, means whether you are investing in government securities, central government securities, state government securities, there will be some spread. There will be some spread between the state government securities and the corporate bond securities. There could be some spreads among the sectors. I mean, the spread of NBFC to central government and infrastructure to central government could be different. So it depends how you are managing your portfolio, whether you are interested to just earn the income through spread, different spreads, or you are just churning through in different sectors. Like last a few months back, or last 2 years back, there was concern about NBFC sector. So people started selling those sectors. So the yield was very high on those sectors. Now, there's a huge news about infrastructure. So the yields for infrastructure is just getting lower and lower. So you can bet on sectors, you can bet on spread, you can bet on duration. Sometimes you feel that interest rates may go down from here. So you may be interested to take the higher duration. Right now, you are feeling that inflation will be higher, so you will take the lower duration. And so many factors are there. So the combination of all spread, sector, duration. Some fund managers are not interested to take any risk, so they will go for the long-term government bonds and not giving more importance to the corporate bonds. Some people are saying no, there will be they feel that there could be some interest rate higher interest rates going forward, so they will be they will be making investment in sectors where the spread is very high. So what are the investment strategies? Investment strategies depend, and there's no complete active or complete passive investment. Most of the institutions use semi-active. I mean, it depends how the market is and how the liability profile is, and depending on that, they do the active or passive strategies. In active strategies, I mean, the churning will be huge, and when you are investing in bond market, the impact cost could eat your profit. So you should be very careful while making transactions in bond market. Sometimes you have some illiquid assets you want to get out from it, but it will be costing you more. So depending on the liability profile, like ours is, we are managing health insurance company. So here our liability duration of the liability is low, and that is why we invest in the lower duration bonds as compared to life insurance companies, where the liability is the duration of liability is higher, and that is why they invest in higher duration assets. The active passive or the liability profile is very important. Then the market scenario. So, I mean, sometimes market is in boom or bust, or just any other conditions. You feel that today the yields are a little bit giving higher, the term premium is very high. So you want to use the barbell strategy. Sometimes some people may say that no, I will use ladder strategy. Depends on the person on the this expectation of your company, and then expectation of the fund manager, and then they use different strategies while making the investments, because there could be a different liquidity requirements. They feel that market may go against their portfolio, so they would like to keep most of the things in liquid. Some people say that why to keep in liquid, because the cost of keeping liquid assets is higher. So there are different strategies used there's no particular strategy. It's a combination of all these strategies. Challenges in any organization is a cash flow predictability is very important, because whatever you plan, you cannot 100%, you are not 100% sure whether when the funds will be required. And we will have to see, in any financial institutions, once you miss any commitment towards your payment, then it is gone. So it is very important to manage the liquidity, to have some liquid assets, so that any cash flow, any unseen cash outflow can be met. The other challenges are economy and policy uncertainty. In the global world, or even, before this corona, nobody was knowing how things will. Nobody had any plan. But ultimately, you have to face it because you are in the market. So there is always an uncertainty in the economy, and then the policy. Sometimes, few times back, Fed was tightening, or then again it is saying that no, we will lose monetary policy until they see the complete growth. In all the central governments, there is no 100% guarantee for anything. So there is always a policy uncertainty. In that scenario, you have to you must keep some some room, so that, and some flexibility in your portfolio, so that if any unseen challenges come, you must be able to handle it, because you cannot say that I can't, because it was not planned. So your portfolio should be very flexible to cope up with any uncertainty we may see going forward. Thanks to everyone.
Thanks, Dheeraj. I think great insights on insurance. I'll straight away jump to questions since we have some time. So to hit the bullseye, other than credit ratings, how can one tell if an insurer is fully capable of meeting all its present and future insurance liabilities? I mean, what metrics one would look at to distinguish between the strongest and the weakest insurer?
I mean, you're speaking from this policyholder point of view.
Yeah, yeah,
See, it depends on. I mean, if you see most of for the general public, what we see the which company is giving the cheapest insurance, which giving companies giving the cheapest insurance, and then we follow that this is the best insurance company for them. So it depends. I mean, if you are I mean, you are a person who wants to take an insurance policy, then you see the claim ratio. You see the I mean, what is the premium you are paying. If you are an investor and seeing the portfolio, then you will see how their assets has performed in last few years, how the growth vis-a-vis the company. I mean, sector growth. I mean, if you see in India, I mean, biggest insurance companies are outperforming the overall sector
understood.
because of their distribution channel, because of, I mean, they have more focus, more visibility, and other things.
Got it. Got it. In terms of, you mentioned about liquidity management and liquidity requirement. Is there a percentage of AUM which is defined by regulation, which you need to keep it in separately, or for meeting claims or otherwise, or is it more depending on the investment policy? Like what kind of limits are we talking about?
See, what happens, the market is very uncertain. The time you have purchased any asset and the time you need to sell it, there could be some differences. To avoid those differences, you must have something in your, in your portfolio, which have a lesser trade impact. So liquidity is very important from the point of view to manage all the liabilities as well as to have the minimum impact. Because see, in this volatility period of in the volatility of the market, today the market is not in favor. Tomorrow it will be. But if today I am not able to meet my fund requirement, I will be selling it at a, I will be selling it at a lower price. So to avoid those scenario, I mean, a company must have good liquids, but the cost of
Sure.
liquidity is very high. If
Sure.
you keep higher liquidity, there will be a lower return.
I'm sorry. So I was saying,
Yeah, it will be.
so obviously, apart from what a typical portfolio management style would be, how does the regulatory constraints, which are given by IRDA, or like the requirements from liquidity perspective, impact your investment portfolio? I mean, are they apart from the stock limits and the concentration and other things, will they be too many constraints to restrict the entire investment portfolio style itself?
See, if you see from their perspective, it is good. But from our perspective, it reduces the return. But seeing the overall scenario, it is good for the sector. If you see in any financial institution, there will be always some liquidity gap. You cannot say that if your liquidity duration is 3, then you will keep the asset at 3. You may keep some higher duration of assets, but you must have those liquid assets so that if a liability arises, you can meet those expenses.
Sure. And in
And
general,
there
is
is a
there a
guideline in banking. There is a guideline that you can keep some gap, but there should be a certain percentage in different brackets. Means 0 to 3 months, 3 to 6 months. There are different brackets. Maturity. You can carry your portfolio. There is some dispensation that keep the gap, but having the liquid assets or very liquid assets with trade impact.
Dheeraj, yeah, your voice is fading. Don't know if that's a bandwidth issue or otherwise.
Sure.
In general, is there a limit on equity exposure within insurance companies?
Yeah, the limit of the equity exposure, because there definitely it is giving the volatility to the portfolio.
Sure.
But we are not investing in equity. There are some companies which are investing 2%, 5%, 10%, depending on their depending on their profile.
Sure. And what is that percentage? I mean, can you quantify? What's the percent?
Uh, Percentage is different from 10, 15% for someone. I mean, health insurance is different,
Sure.
for life insurance is different.
Sure. 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 And given, the majority of your investments is into, fixed income, and given wherever the bond yields are, uh, you know, uh, how do you strike a balance between growth and liquidity and safety of capital? I mean, obviously you can be safe at all times and putting it in GSEC, uh, but how does your view of interest rate matches with what you intend to do from a policyholder's perspective?
First, to start managing any portfolio, you must have a view what is the requirement of funds going forward. Okay, so there is always a cost related to anything. If you reduce the risk, then there will be a lower return. But if you take the higher risk, then it will eat all your return. So there should be a balance in which you must see that. I mean, you must have a sense of the market, how much spread I'm getting between asset classes, between sectors. And right now, you can say that interest rate to go up, you should lower the duration. But the term premium is so high. If you reduce the duration, going forward, your return will be lower, because 10-year in India, 10-year GSEC is around 620, and a 1 year is lesser than around 4. So 220 basis point. You are just losing those interest. So saying that the duration is not the right way to manage it.
Sure. And
You should must have for 3 months, 6 months, and what is the view for a longer period.
sure, sure. What has been the impact of COVID in terms of life versus non-life? Has non-life insurance policies or the business gone up?
See, in COVID, first few months there was some impact. I mean, impact was very bad because it was announced in the month of second half of the March 2020. But later on, 3 months, 6 months down the line, we see that there is a huge recovery. And the same thing for insurance companies. In the peak of the COVID times, people were very much concerned about their health. So there was a huge jump in the health insurance premiums. Now it has normalized.
Understood. And since you come from a bank, banking treasury background, can you elaborate a little bit of difference between what would be priorities in terms of ALM or other things at a bank level versus insurance? A bank would be mostly from a
See,
lending
in
perspective.
insurance, yeah, yes, yes. So see, there is uncertainty in both the cases, whether you take your insurance, whatever you plan, there could be demand for the funds anytime. But in insurance, you have a larger liabilities where people take 20 years, 30 years, 40 years, policy. So you know the precisely when the cash flow is coming, and when there will be requirement of the fund to pay it out. In bank, the liquidity position is very important, because most of the money is in your casa, and anytime it can go out, the requirement could be huge to that end. But you can also say there is a support from RBI to, in repo or reverse repo, they can borrow and lend depending on their conditions. So that is the biggest difference, because insurance company cannot take repo
Right.
from RBI or anything else. So here you have to manage it liquidity such that any adverse situation can be met through these things.
Sure, sure. And in terms of balance sheet structure, I mean, are there any? I mean, I know insurance companies' balance sheet is a little different from what rest of them are, uh,
Definitely, it's a
but
different, complete different. It will,
are there
yeah,
differences
it
between
will be
life and
completely.
non-life, and general versus health and other things?
I mean, definitely, it's a difference. I mean, from bank and insurance, if you say that it is a complete difference. It's a complete difference.
Like for
So
example,
what
life you might
happens?
have longer
Yeah,
duration policies, but on health typically people have
longer
yearly
duration policy,
policies.
because your liability, see, you get the premium for today, but the liability may come from, going forward.
Yeah,
So you will have to make a reserve for that. So reserves is very important for any insurance company. As such, there is no such thing in banking. So the difference between banking industry and insurance industry for the balance sheet is different, and P&L also.
right, right. And often there is a, I mean, we as investment professionals have apprehensions that health insurance companies never make money. Is that true? I mean, do they make money, or are most of them in losses?
I mean, see what happens now. Earlier, it was I told you earlier it was general insurance company. Now, companies have come up with these standalone health insurance
Yeah,
companies,
yeah,
and I tell you, it is a growing sector. So it requires capital. I see the more premium I write and the more business I take, I have to provide more provisioning. So first few years, the more business I do, the higher will be the losses will be higher.
sure.
So it's a very interesting thing. So what will happen? See, in first few years in any insurance company, especially in health insurance companies, it's very difficult to see the profitability. But going forward, then it will be streamlined. When there will be repetitive customers, there will be renewals. Then we will see the growth. But it is not. It can't be said that the profitability is lower in health insurance.
I'm sure.
So there is a stiff competition. I agree with that,
Sure.
but because it is in an initial stage, and everybody is growing, companies are growing by 30-40%,
Sure.
50%. So
Sure.
they are providing more and more reserves. So that is why in P&L account you see the losses.
Correct. And there was a chart where you mentioned penetration as well as density. Uh, Penetration, I'm assuming, would be with respect to the total population, and what population is insured.
Yeah,
And what
total
is
what
density?
total yeah.
How is density measured?
What
How is the density measured?
density? Density is the total premium versus the total population.
Okay.
Now, per head, what is the insurance
Okay. And there we
premium
are
which are paying?
significantly lower versus the rest of the world.
In non-life, we much lower than the global average.
Right, right. And given that off late you've seen a lot of insurance companies now coming to public market, as in getting listed. I think HDFC, ICICI, few others are listed, and now we're talking about LIC, coming to the
LIC,
market.
Star Health
Yeah.
Insurance, and the biggest
Yeah, I mean, a lot of
Dheeraj.
them are coming. So, what are your views in terms of consolidation in the industry, both at an insurance company level and as in terms of market as such?
I feel there will be some consolidation because there are some entities which are not growing for many years.
Hmm.
I would not like to take the names, but the consolidation has also already started. The promoters are changing.
Sure,
Now the question is that how which companies will be merged with whom.
sure.
But there will be definitely consolidation going on in next 4-5 years. This much companies may not be there.
Okay. Should I apply for the IPO?
Uh, it's a tricky question, but see, right now, most of the IPO are very highly priced in,
Right.
and the growth they are counting is very high. Means if this should be the growth, then there will be the price.
Sure.
So right now, I believe that if you're having a high risk appetite, then only you go for it.
Sure. There is an interesting question which says that, aren't we overestimating the market opportunity for both life and non-life? I mean, rather than considering the entire population, shouldn't we be just looking at the number of individuals who are filing tax returns, or, maybe, doing e-commerce transactions or having mutual fund folios? I mean, a classic example is you look at your Arogya Setu app, there are about 17 crore people who have downloaded the same. Mutual fund folios, you will have some number of 1.5 crore. Insurance, the tax returns is like 5.5 crores. I mean, obviously, number of bank accounts have gone up because of Jan Dhan and other things. But is the opportunity really there, given that majority of the sector cannot afford insurance, and they are getting into the state-sponsored or government-sponsored, the Prime Minister, yojanas?
See, I tell you, many people are underinsured, though they are having insurance, but they are not properly insured. If you ask anyone whose income is, let's say, 20 lakhs per annum. What is the total insurance that he has taken? He has taken 5 lakh, 10 lakh rupees insurance.
Sure.
They are not much aware of the term insurance. If you see the term insurance penetration, I can't just give you the numbers. The term insurance penetration is one of the lowest in the in India.
Right.
So here there is the opportunity to sell those products. Same thing with health insurance product. I can just tell you, in last 2 years in my hometown, and I mean, so many of my friends who are not aware of health insurance, they have called me now. Yeah, they are interested to take health insurance because they know it very well. The risk they carry with their health, with this, the financial losses they can make, it's huge. So I mean, though you can say that the bottom 50% of the population is not our customer, if even if you take top 50% or 40% of the population, still there is a huge room for the insurance sector because of the under penetration, because of the underinsured.
Understood. And there are. Can you talk a little bit about the reinsurance, business? How does it work? I mean, does it work also in health and other things, or is it only for life? And how does that?
Not much idea about reinsurance. I mean, I know about the fund management because
Like you as an
I have
insurance
some
company,
global.
would they reinsure their risk with global reinsurance?
Yes, they will. Yes, definitely. I
Okay.
mean, what happens? I mean, we as an insurance company, we give the business to them, and they give the reinsurance. But the business idea, I don't have.
Sure. And
How they
can
will do this.
Indian insurance companies invest abroad in terms of equity or fixed income, like global securities?
Global security as of now. I mean, from my sector, I know it's not.
Like regulation doesn't allow it.
I'll have to check for
Okay.
global because I have not heard anyone around that
Sure.
who has investment outside India, because this trend has started just now with them. Some mutual funds are launching their portfolio
Understood.
and in going for the outside, because see, the primary concern is the safety and the liquidity and the higher predictability. Just now they have introduced the invest in this venture, alternative
AIF.
investment fund.
Yeah. Yesterday,
So
IAIP.
global investment is little bit risky, not risky, but not on the cards as of now.
And in banks, they have something called a priority sector lending, where they are required to
Yes.
lend in. Are there
Mm-hmm.
similar norms in insurance where you're too required to do a rural
No,
cover or something?
no. As of no.
No such cover.
Nothing.
Okay.
There are some requirements that we have to invest in central government securities, minimum, not state government, but there is a minimum requirement of central government, and the certain percentage should be with central government and state government. Like like SLR in the bank,
Sure.
we have also certain rules.
Sure. And in these, how different is the investment team structure versus banks and mutual funds in insurance companies? I mean, it is more analysts and CIOs
Huge
and
difference.
so in your organization,
Huge difference. See what happens in bank. In bank, see, you have several desks. Since I have worked on several desks of fixed income and money market. So I have worked on CRR, managing CRR.
Sure.
I have on the desk of SLR trading and non-SLR trading, then raising funds for those CD, CPs. I have been on the equity side, and then there is a derivative desk also. We can also invest in derivatives, insurance companies, but not that much is involved. We are not much involved in derivatives as of now. But in banks, in forex desk is there, derivative desk is there, then equity desk is there. So the bank's treasury is more vibrant as compared to the insurance company, because there the flows are higher, the volumes are higher, the instruments are very high. So there is a huge difference. Number of you are saying that number of investment managers are also higher in banks. Sure. As compared to insurance companies.
Sure. Dheeraj, thank you so much. Sorry, go ahead. I'll let you finish.
No, just like telling.
No, I was saying thank you so much for sharing your insights with us. As a reminder to our listeners, please do complete the evaluation survey that has appeared on your screen at the end of the session. CFA Institute / CFA Society members can claim professional learning credits by logging on to their online professional learning tracker tool and record their attendance. If you're not registered, please do look out for our next webinar scheduled on 8th of April about career insights in portfolio management with our speaker Prateek Agarwal. And on 22nd April, our practitioner insights on big data and fund manager evaluation by Sabi Ashar. Thank you so much for participating in today's webinar. The presentation link is available for you to download. We look forward to your feedback and survey for enabling us to plan these kind of events. Thank you, Dheeraj, and thank you, to our entire team
Thanks.
for
Thanks,
taking
Vidi.
care of this
Thanks.
webinar.
Thanks, everyone, for the
Thank you.
opportunity. Thanks.